Almost a full month into the year 2023. Hard to believe that, right? Today is January the 29th. There's a couple more days left in January, and then we're 1/12 of the way into 2023. We thought in the back half of the program we might think about or share some of the investment themes that are starting to sort of take place for the year. So welcome into the program. This, of course, is Dollars and Cents. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we got a team of great folks that stand ready this week to help you change your life with a successful and cost-effective financial plan. So many of the themes, as you might well imagine, in 2023 are sort of carrying forward from 2022, right? I mean, that kind of makes sense. This battle, as we've described it for many, many months now here on the program, between interest rates and inflation, the trend, lower inflation, potentially leading to interest rates that maybe don't rise quite as quickly as we saw during the course of 2022. We were talking earlier in the program about the market so far seeming to follow that belief that perhaps those interest rate increases won't be as dramatic or as rapid as what we saw during the course of last year. Time, of course, will tell on that. Certainly the Federal Reserve hasn't made any grand announcement about what it plans to do, but a tremendous amount of speculation that perhaps the interest rates are where they need to be because have seen in some of the inflation data where some of the inflation data is starting to shift down. Certainly from June's 9.1% to the most recent reading at 6.5% for inflation. Yeah, that's certainly better. Similarly, and this was certainly a trend that developed last year that we think carries over into this year, the notion of value versus growth. If you're an investor, you know that there's a difference between value and growth. Growth companies' tendency to describe those as more technology companies that where the expectation is more about what their future might be, versus a value company, generally thought of as a dividend-paying company. Those companies, a little bit more established business model. Think about, kind of more your Johnson & Johnson or companies that pay a regular dividend on a regular basis. Last year was perhaps the largest outperformance of that value over growth in, I think, about 15 years or something like that. So certainly the growth or the tech stuff certainly took a back seat, and the dividend orientation, those dividend-paying companies wound up sort of being more of the leaders, if you will. So certainly some things to consider. Importantly, though, as we talked about a couple weeks on the program, don't necessarily throw out all the growth stuff, throw out all the tech stuff, because the reality is there's tremendous amounts of opportunities when you think about cloud computing, all of the infrastructure that's needed to accomplish that, and healthcare that ultimately will continue to be massive areas of growth. But surely some more unique themes, if you will, are starting to emerge that are unique to 2023. So we thought we would kind of share some of the thoughts on that. Keep in mind, here's the caveat, in terms of your overall investment mix, your overall portfolio allocation, you always want to kind of take a step back and look at it from an overall perspective. Beyond just kind of, okay, I've got X in stocks, Y in bonds, and Z in cash. The reality is you want to drill down, and we've certainly talked about this many times over the years on the program. You want to drill down a little bit and know the types of companies that you own. Are they large companies? Are they small? Are they in the healthcare sector? Or are they in the energy sector? Same thing on the bond side. Are they issued by government? Are they issued by corporations? Are they issued by municipalities? Is the duration short? Are they shorter term bonds, or are they longer term bonds? But certainly important to always understand and look at that overall mix. On this segment, we're talking specifically about sort of some areas that it might be interesting to drill down a little bit and take a little bit closer look at what's going on in those areas. And to start that list, we'd have to start the list off with bonds. Much like growth companies, as we were saying earlier, might not necessarily want to throw out all of those bonds. Certainly no question bonds did terrible last year, probably the single worst year for bonds, and certainly a bit of an anomaly, if you will. Typically, stocks and bonds trend oppositely, right? When stocks go up, bonds kind of stay stable or go down maybe a little bit. When stocks go down, bonds are usually there to kind of pick up the pieces, if you will. The problem is that last year was the first time in the past 45 years where both stocks and bonds declined relatively dramatically. So it is rare. So we would urge people to not, if you've got bonds in the portfolio, don't start throwing the bonds out the window. Just as we would say, if you have stuff that's more on the growth side, tech side, hopefully you rebalanced prior to last year, and you should be doing that on a regular basis. The reality is you certainly wouldn't start to throw that stuff out at that point in time. Be patient on those bonds, because history suggests that bonds, much like stocks, do recover after a decline. If you look at the 6 prior rate cycles, if you invested in bonds at or close to the end of those tightening cycles, you were certainly rewarded. So much like stocks, bonds recover, and so that's certainly a concept that we're seeing beginning to play out during the course of the year, where you're seeing some of these bonds and bond funds start to show some positive overall results since the beginning of the year. We think that trend probably will continue because they're not raising rates as quickly and as dramatically as they did last year. Otherwise, that would really kill the economy. So as that pace of those increases slows down, then you should also correspondingly see some recovery on the bond side of things. Next up on the theme list, if you will, is dividends. Well, that's probably not a new one. That's probably an oldie but a goodie, but certainly bears repeating, because dividends, and we've said this before many times on the program, what people forget is just how much your overall return as an investor is actually attributable to dividends. If you go back all the way back to 1926, dividends, in fact, account for about 40% of the actual return, of the actual cumulative return that you receive by being an investor over time. And so that's an important piece of the equation. One of the reasons why we don't really like these insurance products or annuity products that are sort of quote unquote tied to the market, the reality is they strip out dividends. Well, if you're doing that, then you're eliminating 40% of the return. So that doesn't seem like a good deal. In particular, if you look at periods of time where you have higher rates of inflation, those dividends really matter. If you think back to the 1970s, which is obviously an inflationary period of time, dividends accounted for almost 70% of the return in the course of that decade. Similarly, in the 2000s, it was about the only positive return because of the 2008 financial decline. So those are just some of the themes that we would encourage you to be thinking about that are probably going to be predominant for this year, 2023. We've got a few more on our list as well. So when we return, we're going to continue this conversation about some of the investing themes to be aware of for the year 2023 here on Dollars and Cents with Joel Garris of Nelson Financial Planning.